If Apple's stock price at expiration falls below the strike price of the call option, let's say to $150 or $100, the call option would expire out of the money. In this scenario, 1. Apple's price at 150. If Apple's stock price settles at a 150s at expiration, the call option would not be profitable to exercise. Since the market price is below the strike price of $175, there is no financial incentive to exercise the option. Consequently, the option holder would let the contract expire worthless, resulting in a loss equivalent to the premium paid for the option. 2. Apple's price at $100. Similarly, if Apple's stock price drops to $100 at expiration, the call option would remain out of the money. With the market price significantly below the strike price, exercising the call option would not make financial sense. Consequently, the option holder would let the contract expire worthless, incurring a loss equivalent to the premium paid for the option. In both scenarios, the option buyer faces a loss equal to the premium paid for the call option. This loss occurs because the option holder does not exercise their right to buy the stock at the strike price, given that the market price is unfavorable. Therefore, the premium paid for the option represents the maximum potential loss for the call option buyer in these circumstances. It's essential for traders to carefully assess market conditions and price movements when trading options to mitigate potential losses and optimize their investment strategies. Additionally, understanding the concept of out-of-the-money options helps traders manage risk effectively in their options trading endeavors.